Please welcome their chair, the Chancellor, George Osborne.
Well, ladies and gentlemen, let me welcome to the stage my fellow guests. So I've got Christine Lagarde, the Managing Director of the IMF, Jim Flaherty, the Finance Minister of Canada, and Wolfgang Schäuble, the Finance Minister of Germany. And please thank them for coming today to this conference. Christine, why don't you sit there? Jim, you sit at the end. Well, we were talking beforehand about how to handle this session, and we thought the best thing to do was give some brief opening remarks, but then throw it open to questions from you. And so both myself and my fellow panelists here will not speak for very long, and please, we would enjoy an active discussion and engagement with you. One of the reasons that my colleagues are here is that tomorrow Britain chairs the G7 finance ministers meeting, and that's a two-day conference that happens over the next couple of days, where obviously we have the seven largest Western economies, if you like, and also the European Commission and the IMF represented. And we will be talking about the global economic situation in an informal setting. It's a less formal gathering than some of the other meetings and discussions that we attend. We will be talking about how to nurture the recovery. I think there's no doubt that there is greater stability, and that is reflected in financial markets, than perhaps there was last year. But that doesn't mean we should let up in taking the necessary steps to secure that recovery and ensure a sustainable recovery. We will, of course, be talking about the fiscal issues that we all face and how we can make sure that our public finances are in good order. We will be talking, since we'll be joined by the central bank governors of our countries, about monetary policy and what that can do to support demand. And of course, there's been a lot of interesting monetary innovation over recent months. Indeed, Mario Draghi at this event last year said his famous comments about doing whatever it took to support the single currency, and that was the beginning, I think, of a period of greater stability. But we'll also, of course, hear from the Fed and from the Bank of Canada and from the Bank of England. And we'll also be talking about the, James is pointing out that, of course, the Governor of the Bank of Canada is soon to be the Governor of the Bank of England. So we'll both be interested in what he has to say at the conference. And then I think, and I hope we have time in our G7 meeting to talk about some of the structural reforms, not just that we undertake individually as countries, and of course the primary responsibility is on national governments to undertake structural reform to make sure we're more competitive and more productive. But I think also to confront some of that pessimism that says there's nothing the international community can do collectively to improve the performance of the world economy. And I would take, for example, free trade. There's been disappointment at the stalling of the world trade talks. But actually, if you look at the initiatives that the EU has undertaken in terms of seeking free trade agreements with Canada, Japan, there is real prospect there of progress. The President of the United States has talked about the opportunity of a transatlantic trade and investment partnership, which certainly in Europe and here in the United Kingdom, we are very keen to progress, and there is the Trans-Pacific Initiative as well. And we'll also be talking about financial regulation. I know many of you are involved in finance, and addressing some of the collective issues we face about the regulation of the global financial community. As I say, it's an informal gathering. The G20 is the primary body that deals with the global economic rules. But it's sensible, I think, for the seven largest Western economies to get together in this informal setting. So that will be our agenda over the next couple of days. As I say, the priority is to now nurture the recovery, build on the stability we've seen in recent months. and that is what we'll look forward to talking about in the next 2 days. So that's just by way of introduction. I thought I would ask Christine to give us a perspective from where she sits on the global economy, and then maybe ask Jim to give a view from Canada and from the Americas, and Wolfgang to talk about Germany and the Eurozone situation, and then we will throw it open to questions and comments, and we'll take this session wherever you want to take it. Christine.
Well, thank you so much, George, and good afternoon to all of you. It's lovely to be back in London with the community of business people, investors, and not just before the Olympic Games, I have to say, which was one of the niceties of your last conference. And Mario Draghi certainly started something, but he certainly also started the spirit of the Olympic Games in London. George, you've asked me to comment a little bit on the world economic outlook as we see it. And it's been known to those of you who read the financial press that we characterize the current situation on a global basis as a three-speed recovery, which we fear might turn out to be a three-speed economy. And that three-speed is really characterized by, one, the emerging market economies and the developing countries leading and driving the growth show, if you will, by an approximate 5.3% as we forecast it for this year. And those are clearly countries that have done reasonably well throughout the crisis and that are taking full benefit of often the restructuring that they had to go through themselves back some 10 years ago, especially if you look at some of the Asian countries that went through the Asian financial crisis. So those are the fastest growing ones. Then you have the second category, which we call the countries on the mend. That includes certainly the United States and countries like Sweden or Switzerland, for instance, probably Canada as well, actually. And a few other countries like Australia and New Zealand that are also in that particular category, where growth is picking up, where some issues have been addressed. Clearly in the United States, the financial sector has been mended a lot more than in other parts of the world, and that has, in our view, caused that country to pick up a bit faster, although it doesn't mean to say that all their issues have been addressed, and particularly their fiscal consolidation process, and particularly its anchoring in the medium term, which is not to be seen, and where too much upfront consolidation is happening as a result of not just their fiscal consolidation path, but also their sequestration that happens sort of abruptly and without much regard to where it hits. And then the third category, which is having a tough time sort of shifting into gear, which is predominantly Europe and notably the Eurozone, but also to a certain extent, with a big question mark associated with it, Japan, where clearly the combination of monetary, fiscal policy and structural reforms is completely different from what we've seen so far. So that's where we see that sort of three-speed recovery in process, with short-term risks certainly on the downside still, although some gradually improving, particularly in the US, and medium-term risks that are either continuation of existing risk that we had to deal with, including this sluggish growth that we see particularly in this part of the world, but also the potential consequences and some unintended consequences of very innovative monetary policies undertaken by central banks. Now, the whole question, and I think the virtue of this forum, is really to see how investment, foreign direct investment, and an improvement of foreign direct investment can actually transform that three-speed recovery into a full-speed recovery. And here, it's a combination of both FDIs, investments altogether, as well as improved trade through less protectionism as we've seen it. And I would like to just conclude with mentioning a couple of numbers which I think are relevant. When we talk about investment, clearly we can tell that it has been sluggish, both in advanced economies and, surprisingly, in emerging markets as well. And it has been sluggish because it really took a big hit in 2009. I think the number is precisely $1.8 trillion fall in 2009, slight pickup in 2010, 2011, but certainly it hasn't yet gone back to the pre-crisis levels. So there is clearly a shortfall of investment that if it could be filled, would certainly help with growth. That's in the advanced economies. In the emerging market economies, which is more surprising because there is clearly a flow of capital going in their direction, it's a combination of lack of infrastructure in countries like India, for instance, or bottlenecks in many of the emerging market economies that are slowing down the process of investment in those two countries. On trade, we don't have as bad numbers actually, but one that is quite interesting about protectionism measures. And if you look at the WTO reports over the last few years, you can see that throughout the crisis, that is ever since 2007, on an aggregate basis, the G20 countries, about 85% of total GDP, have taken on an annual basis about 200 protectionist measures. So that says a lot about how much could be removed to actually encourage trade, which has increased over that period, no question about it. But it tells us how much more it could have increased had there not been those 200 measures. Voilà.
Eh bien. James.
In French or English? No.
Well, you can do both. Yes.
Well, thank you for the invitation to be here. I'll be, I'm short, but I'll also try to be brief. It took a moment. In terms of the way the globe is going, I think we all agree that things are better this year than they were last year. But we're not out of the woods yet. And I've been watching this movie since 2006, and then the credit crisis in 2007, and the crisis in the real economy in 2008. Then we all agreed in the G20 to stimulate our economies in 2009. Most of us did, which meant deficits, and now we're trying to get back to balanced budgets. But as I say, the problems persist. I think we need to make sure that we, as governments, avoid protectionism, encourage open trade, encourage open trade in currencies as well. Canada has had a floating currency for 40 years, despite times that one might have wished to intervene. We never have. And I think it's important that we emphasize that in the international community. Governments can also deal with their budgets. And I think there is a balance to be struck between medium-term fiscal plans that reduce debt-to-GDP ratios, which is what our leaders agreed to at the G20 meeting in Toronto, and subsequently confirmed in Los Cabos in Mexico. I think there's a balance there between medium-term fiscal responsibility, which I think, by the way, is a sine qua non for long-term economic growth. If governments can't get sound fiscal policy in place, then they can't get anything else right either, whether it's education, healthcare, social services for their populations. That's the essential element that must be in place, which is what we are doing in Canada. We'll be back to a balanced budget in 2 years, and then we'll run surpluses and we can pay down public debt at that time. At the same time, and we've all had discussions about this, and I imagine we will this weekend as well, at the same time, one can provide incentives in the economy. I'm doing it now in Canada, another infrastructure program, another skills training program, more tax assistance to manufacturers. Yeah, this isn't a single horse that one must ride. You can do both, but again, it's striking that balance so that you have growth in the economy at the same time that governments are moving in the correct direction fiscally. Why is that important? Well, you know, it creates fiscal direction, creates certainty. If governments have goals and they meet them, it creates confidence, creates investment, creates economic growth, and it creates jobs, all of which are very desirable, particularly if one is elected in government. In Canada and North America, we're seeing modest growth, and I mean modest, 1.6, 1.8, 2.1, 2.5% real GDP. The first quarter was a little bit better than we thought it would be. First quarter in the UK was better than I think what was anticipated. So there's some encouragement there. But I'm still very cautious. There's a better U.S. housing market. But again, these are modest changes. And so I'm cautious about how we act moving forward. We make sure we stay on the correct track fiscally as an example, and to ensure we create business confidence. In terms of foreign direct investment, we welcome foreign direct investment in Canada. We've put in a couple of new rules about sovereign wealth funds, which we will watch more carefully than we do other investments. This is all to ensure that investments when they're made are made for commercial purposes, and that's our goal. But Canada was built on foreign direct investment, and we look forward to continuing that. I'll stop there. Thank you.
Jim, thank you. Wolfgang.
Thank you, George. I would like to start with a short remark. This morning in Aix-en-Chapelle, it's a famous international prize on Charlemagne. It's a famous prize. I got it last year, therefore it's very famous. Was delivered to the president of Lithuania. And that reminds us that European integration, that European unification is much more than only an economic process. In a political way, in a historical way, it's an unbelievably successful process. We have achieved, and we have even in economic matters, achieved to transform the former member states of the Warsaw Pact, which were all beyond the Iron Curtain, not only in Germany, but also in Middle East and East Europe, and we did it very successfully. The Baltic states, Estonia is already a member of the Eurozone. Latvia will join the Eurozone probably the 1st January next year. And Lithuania has decided to join as soon as possible, probably 2015. The Baltic states have the highest growth rates in Europe, higher than UK, by the way. It's quite astonishing. And even Poland and other Eastern member states are very well doing. Having said this, as a result of the financial crisis, markets became aware of the problem of sovereign debt. Until the financial crisis in 2008, markets didn't care on the sovereign indebtedness in the Eurozone, which is, by the way, half of other major economies in the world. Then the markets have detected that, of course, the construction of the Eurozone, a common monetary policy, 17 half-sovereign member states in fiscal policy and economic policies, very complex, very difficult, sometimes boring in decision-making. Everything is true, but nevertheless it works. And sometimes I tell to my colleague, have you ever tried to unify, to integrate 17 or 27 sovereign nation states? Therefore, it's not as easy, but we are doing it step by step, and we achieved in the last 3 years, and that is what I should contribute to this discussion in the beginning. We have been rather successful. So, crisis of confidence in the European currency it's not solved, but it's the lack of confidence has diminished. We have achieved, and the deficits in all member states of the Eurozone have been halved in the last 3 years. We delivered to the Toronto commitments as a Eurozone as a whole. The SWIFT in competitiveness, which is another basic problem of our common currency, economies with different competitiveness, and of course, the common currency was created to make pressure on all member states to increase competitiveness, which is in the globalized world of an absolute must. But some forgot it in the first years, joining low interest rates and now we have to change it. We are doing it. The differentiation in the labor costs have halved in the last 3 years. Therefore, even the targets and the balance sheets of ECB has halved in the last couple of months. Therefore, we are in real figures, we are on a good track. We have increased the legal construction of the Eurozone to get decisions in common fiscal and economic policy. It's complicated, but it works. It's much better than it used to be. We have enough room of maneuver not to react in the wrong way in a case of a weakening of conjuncture. It's quite clear. We have seen it in the last week with a judgment of European Commission in giving a little bit more time for Spain and France. It's absolutely okay. German government has been, what was for some people surprising, supportive for this decision of the government. But of course, the precondition is that everyone sticks to the medium-term obligation to deliver what we have all achieved. We have to reduce sovereign indebtedness. We have to reduce global liquidity. I am very concerned. We will discuss it with the governors in the coming days. We have some increasing problems in interest, in too low interest, and interest is not longer the mechanism for the right decisions on allocating resources. It's becoming more and more critical. So we have a functioning mechanisms for European solidarity. By the way, Portugal and Ireland will gain access to financial markets in the coming year, as has been agreed 3 years ago. That's on the way. The interest for sovereign bonds have come down. Spain is about 4%, below 5%. Italy is below 4%. And Ireland is lower. Irish interest rates are lower than they used to be before the crisis, the Lehman Brothers crisis. Even Greece is achieving remarkable success in the last couple of months. Greece is very difficult, it remains very difficult, but unemployment is going down in Greece. Exports in third countries are increasing. Greece achieved in the last months a primary surplus, what is not sufficient, but it's much better than it used to be some months ago, and therefore I think we are in a better mood, and even we have regained confidence in markets. Therefore, the euro crisis will no longer be the main obstacle for a global economy. What we not have still is insufficient growth in Europe. That's true. Therefore, we have to work on this, but we have to work step by step, and I think in this direction we are rather successful.
Thank you very much, Wolfgang. So questions and comments, and I think we've got the first one over there.
Bank of America. I'll try and sneak in 2 quick questions if I can.
You're allowed one.
Am I? Okay.
You shouldn't advertise in advance you want to ask.
I was going to, exactly. Well, on the financial transaction tax, which I think perhaps there'll be some questions on, I wanted to actually perhaps ask a slightly broader question, which was raised this morning, where somebody contrasted the amount of financing of companies and institutions in the US that's done through the capital markets versus Europe, where a large percentage is done through the banks. And I don't have the exact statistics between the two. Does the panel think that that matters as we think through the medium-term solutions for Europe? Because a lot of the debates and the legislation we see seems to suggest that the capital markets are things that are not a focus for Europe as such. But it is an interesting contrast that if you look at the US economy, a lot of institutions, middle market companies, et cetera, are financed through the capital markets versus Europe.
Well, maybe I'll say something first and then ask.
What was the question?
It's about, in Europe, a lot of financing is bank finance, whereas in America there's deeper capital markets. And is that relevant, and what can we do about it, I think is the gist of the question. I mean, I would say, speaking from a UK perspective, I think we would like to see more a deeper corporate bond market, and a corporate bond market that extends to smaller and medium-sized companies. I mean, one of the consequences, as you would know, of the financial crisis over recent years has been a lot of our larger corporates have actually found it easier now to get financing by going directly and raising that financing rather than going through the banking system. And the impaired banking system has caused that to happen. But it's proved much more difficult for medium-sized companies. And certainly we have developed a number of initiatives to try and deepen that. You mentioned the financial transaction tax. And obviously there's a difference of view about this. Britain is not proposing to take part in the financial transaction tax that some of our colleagues in the European Union want to take part in. And I think we would have an argument that we want to see Europe develop its financial markets. We would also want to make the argument that it's a good thing for the whole of Europe that we have London as a global financial centre. It's not just a British asset, it's a European asset. And of course, we're not against financial transaction taxes in principle. We have stamp duty on equities in this country, although in my last budget I abolished stamp duty on the AIM market. So you can have transaction taxes. I think where we have had concerns is over some of the extraterritorial reach of at least the European Commission's proposal, which is not the same as some of the ideas that individual member states have had. And we have launched a legal challenge with the European Court of Justice around the extraterritorial nature of the financial transaction tax that that the European Commission has put forward. But hopefully we will be able to resolve these differences of opinion amicably. Wolfgang.
I would like to add to the issue of financial transaction tax. I think for the time given, this year, next year, it's not your major problem. I would like to invite you all to our next meeting of European finance ministers. On Monday we have a meeting of the Eurogroup finance ministers without George. On Tuesday we have a meeting of the European finance ministers with George Osborne. And in the meeting of the European 27 finance ministers, we will also discuss the issue of financial transaction tax. We are just beginning with the discussion. And of course, everybody is aware we have different views in some member states which have taken the initiative. And we are all in discussion with all the experts, with all the concerns, with banking sectors and so on. It's a long way to go until we will have a decision. Therefore, it's not my major concern, to be very frank. I stick very much more in saying we have to complement what we have achieved in reducing increasing the right incentives for all member states of the Eurozone. We have made what I just said, a lot of progress in rebalancing the different situation in competitiveness, because we need, and that is very important for Europe as a whole and for the Eurozone as a whole, in this changing world of the globalized world. We need to be very innovative. We need a lot of structural reforms to get a sustainable growth, which will not be in comparable figures with the figures of emerging economies in other parts of the world, to be very frank. But if we achieve in Europe on the basis of the European demography and on the basis of the European social standard, which is totally different to other parts of the world, if we achieve a sustainable growth, we need high competitiveness. And that's what we are delivering. It needs a lot of structural reforms. We need a lot of reforms which make a lot of problems for our populations. Therefore, I mentioned the experience of the Baltic states, which had a lot of efforts to deliver to join the European Union and the Eurozone. They did it very successfully, and that is the lesson we are doing all together. And the major problem in Europe is actually to fight the high rates of unemployment in some member states of the European Union, which is our major problem. And we will have to speed up in fighting youth unemployment, because otherwise we will lose the support in a democratic way in some populations of the European Union. And therefore we have a difficult task in enhancing growth, but in a sustainable way. And in Europe, confidence is the most important thing for enhancing growth. When I started as finance minister, I was very much questioned, how will Germany stick to its obligation to reduce its deficit? Because I started with a high public deficit 3 years ago. 1 year and a half, 6 months later, the then American Secretary of the Treasury came to Berlin and said, please be careful not to reduce your deficit too fast. Think in growth. My answer was, to enhance growth in Germany means to regain confidence. When he came 1 year later, he said, oh, we have been rather successfully, because we reduced our deficit and we had a growth by 3.7%. And the reason was German investors, German consumers, German population regained confidence in the sustainability of our long-term financing. And that was the very reason. And that is the main issue. By the way, continental Europe, it's a little bit different to the UK. You are right, we always have more financing by banks and compared with Anglo-Saxonian economy. Maybe we will change it step by step, because we have common experience. That's what I...
Can I, just a microsecond on that, because it's clearly an important point. You indicate the different pattern between US companies, European companies, and their financing. 80-20, one way and the other way. Capital market, banks. What it creates at the moment is a real discrepancy between the large corporate companies, many of them represented here, that couldn't care less, because they don't need to access the banking financing. They can go to the capital market, and they can do it here in London, they can do it elsewhere if they want to. But the small, medium-sized enterprises throughout Europe, and I'm sure that's the case in pretty much all members of the European Union, cannot access the capital market. And that's, in my view, an area where the Europeans together can actually do a bit more homework. Euronext is nice to have, but there are probably Alternext of some sorts that can be developed, expanded, and appropriate rating and ranking institutions who can actually develop their job in helping out the deepening of this market. Because otherwise, you'll have this dual financing system. The corporate accounts, big corporate can go where they want. SMEs have a really tough time. And that raises the second issue, which is that of proper monetary transmission, and where the private sector investment decision meets the monetary policy decisions that are made at central banks levels, where the attempt is to actually try to lower the rates at the receiving end, and where it's not happening.
Very quickly, George, on the proposed financial transfer tax, when this, just so that no one is mistaken about this, when this has been discussed at the G20 level, there is not a consensus in favor of this. Canada is opposed, so are most of the emerging economies. The major reason for that is that it is, in effect, a tax on customers of banks. The cost will be passed along to customers, and it wasn't customers' fault that the banking crisis happened.
They're always quite lively, the discussions of the financial transaction tax at the G20. Who has the next question? In the second row here. If you just also, if everyone would say who they were and which institution they represent, if they represent.
Ed Nussbaum from Grant Thornton accounting firm. This morning, the Prime Minister talked about upcoming free trade agreements between European Union and Canada and the European Union and the US. And I think everyone in this room, I would suspect, would see that as a very positive move, very beneficial, benefiting all parties involved, including Estonia. But I'm curious from your perspective what you see as the real benefits and the real impact of those free trade agreements.
Who wants to start? Jim?
Well, for us, a medium-sized country, it's a great opportunity for access to the largest economy, the European Union. It's an incredible opportunity for us. The NAFTA, the North American Free Trade Agreement, has been in place for more than 10 years and has been an incredible success in terms of economic growth and jobs, not only for Canada, but also for the United States and Mexico. We're very keen on free trade agreements.
I mean, I'd say something, and then maybe ask Wolfgang to say something. I mean, one of the, I think one of the challenges for the United Kingdom, and where actually I think Germany has been more successful than the UK, is I think Germany was more successful over the last decade in connecting itself to the fast-growing parts of the world, and German exports to China are incredibly impressive. And in the UK, 50% of our exports go to the rest of Europe, 40% to the Eurozone. And we see the free trade agreements as an opportunity for the whole of Europe, including, of course, the United Kingdom, to connect ourselves in a better way to North America, and we're also seeking a free trade agreement with the United States. With Japan, we've just recently concluded a European free trade agreement with South Korea. And I think they are the second best to the Doha talks. We are dealing with the second best, but the Doha talks fell apart. I think that's a matter of huge regret. But rather than just leave it at that, the European Union is now pursuing these bilateral agreements. And I thought one of the most encouraging things was that the President of the United States, in his State of the Union address, actually mentioned the potential free trade agreement with Europe. So, I do see, I mentioned in my opening remarks, I think when you ask what can the world do and what are the available instruments for improving the productivity of economies and the growth potential of economies, there is something at our feet which we can pick up. And certainly Britain, I think this is also the case of Germany, are among the strongest advocates in the European Union of getting these deals done. And certainly from our point of view, when it comes to the free trade agreement, for example, the Transatlantic Trade and Investment Agreement with the United States, we want to make sure it's as broad as possible and includes areas like financial services, which is obviously a big industry for the United Kingdom, but where there's an enormous transatlantic potential. Wolfgang, do you want to?
I have only to add, first I agree we are tackling the second best, but we often have to concentrate on second best solutions because the best solutions are not available. Therefore, we concentrate on second best, and I think it's simple. Of course, I don't see that it's only a matter of free trade agreements to be successful in exports in emerging markets, to be very frank. It maybe it's also a matter of small and medium companies, which I have to add what Christine Lagarde just said. The stronger small and medium companies are in an economy, the strongest economy in Europe. That is what you can see, and therefore we all rely on support small and medium companies in Europe to fight unemployment and to raise growth. But having said this, we are strong in favor of any free trade agreement, and I hope we will all agree when it will become concrete, because my experience is if we come to agriculture, it becomes concrete, and then we have some problems as well. I know it from all negotiations on European budget, for example, and I know it's also in the Doha round, a very difficult issue. It will remain even in the... Nevertheless, I think it's optimistic, since we on both sides, an optimistic sign, on both sides of the Atlantic, agree that we start with the second best lesson, free trade, transatlantic zone. And we can enhance in this way and support the Doha negotiation as well. That's in our best common interest.
Do you want to say anything, Christine, or should we take?
You could actually end up with the second best and half the first best, which would not cost too much, because the trade facilitation side of the Doha round might be something that could be agreed without all the trouble that you referred to. So that would certainly be an improvement and would not cost that much in terms of tariff reduction.
Next question over there.
Nicholas Beale from CITEB. I think most of us from the business community greatly welcome the effort to get deficits down on a sort of 3 to 6 year time frame. But it seems to me, at any rate, that for much of the G7, if you take a sort of 10 to 30 year view, the rocketing entitlement spending is going to sort of swamp anything that's done in the shorter term. Now, as a non-politician, it seems fairly obvious that there needs to be a long-term program to raise the retirement age and a long-term program to move to something towards more like a Singaporean model, which gets better health outcomes for about half of the EU's health expenditure and about a quarter of the US's. But I can see that from a political point of view, this is jolly difficult. So perhaps addressing this to the former politician on the panel, who now is above politics, is this something that you can encourage your colleagues at G7? Because taking collective action to deal with this might be politically less difficult than one country sticking its neck out and saying, frankly, we've got to raise the retirement age by 6 months a year for the next 20 years.
Which is actually what some countries have actually done. I was in the Netherlands a couple of days ago, and that's one of the reforms that they're working on, to actually push into time, but also link it to the longevity and the improving longevity. But you're right, the issues of entitlement are going to haunt many of the G7 countries for a long time, and the sooner right measures are taken that will anchor in the medium term and in the long term the determination to actually reduce the weight of entitlement programs, whether it's pension, whether it's health, whether it's welfare. It has to be rebalanced relative to GDP and anchored into the medium and the long term. And collectively, it's always a little bit easier. You're right.
I mean, I don't know whether Wolfgang, do you want to say something about pension ages and entitlements in Europe? Or?
We have started in Germany some years ago to raise slowly but steadily the pension age because it's a must. If you look at the demography, it's a must. It's not to be disputed. But I would just add, I can understand that in some of our member states in Europe, as long as you have so huge figures of youth unemployment, it's very difficult to get a political understanding that you raise pension age because people are saying then young people have even longer to wait, and therefore you have to have in mind, maybe we should have first success in reducing youth unemployment, and then we will get much more room of maneuver for rebalancing what is needed in our social systems.
Many of us have aging societies, of course. The good news is we have healthy aging societies. People are living longer and healthier. So it makes sense to increase pension and retirement entitlement ages, which is what we've done in Canada. But you've got to give people notice, 12 years, 15 years, so that they can adjust their savings to deal with the new reality.
I mean, and in the United Kingdom, I agree with the premise of the question that tackling entitlement costs and the cost of an aging society is a real challenge for Western democratic societies. And in the United Kingdom, where we've brought forward the increase in the pension age to 66 to later in this decade, we've brought forward the increase to 67 in the next decade. And actually, because of a reform taken some years ago, the female pension age is increasing to 65 as we speak. So, and these changes, when you're a finance minister, the savings dwarf almost everything else you do. I mean, they are absolutely enormous savings. And I think they enable you to go on providing a decent retirement income. So you're not necessarily reducing the entitlement of people who are retired, you're just reducing you're increasing the age at which that retirement entitlement kicks in. And of course, when these were first put into practice, these pension systems, life expectancy was dramatically less. So yeah, I found it actually one of the less controversial things that we've done, and yet probably has save more money than anything else we have done. So, question over here.
Davide Serra from Algebris Investments. Christine, you talked about the fairness of access for financing for SME. But as Global Finance Minister, you should probably also have a consideration of corporations like Google, Amazon, that pay at corporate level less than 10% tax. So these are disruptive companies, they're clearly successful and innovative, but they have a massive implication in Europe because basically they put out of business SMEs, they pay taxes of 35% plus, and they only pay 10% taxes back at home. And the reason is because global finance ministers cannot agree on anti-illusion or tax illusion initiative. Could you present what's your initiative? And I have to say thank you, Osborne, for tackling this, at least in the UK, to set an example for the rest of Europe.
Well, so I'll say something first. First of all, thank you for that. Look, I mean, I'll give you the British perspective. I'll say something also about what a number of European countries, Britain and Germany working together, in fact, Wolfgang and I started this last year, are doing on the development of the international corporate tax rules. I mean, first in the UK, we are, unapologetically and aggressively reducing our corporate tax rate, and we are reducing it to 20%, and that is going to give us the lowest corporate tax rate in the G20, or the lowest equal. I'm a low-tax conservative who is happy to make the argument that we want to attract business to this country, and the fact that we have so many companies here who've come to make their home here and invest here is good news for my country, and hopefully good news for global prosperity. I think we have a challenge, however, with some of the rules around base erosion and profit shifting. The tax rules were put in place by the League of Nations in the 1920s, and they do not reflect the modern, heavily interconnected global economy. Now, rather than rushing to take unilateral action in the United Kingdom, which I think would be very damaging to the UK and achieve very little internationally, we are working with many other countries, like Germany, like France, like Australia, and we have asked the OECD and the IMF, Christine reminds me, to got to make sure we treat all these international financial institutions very equally. But we've asked them to look at the global rules on this, and they are reporting back to the G20. We will probably discuss it informally at the G7 briefly, although it won't be the main topic of discussion. And in the G8, which Britain also chairs this year, getting the tax rules right is a big issue. But let me be clear, we should do this internationally, we should do it in a measured way. The last thing any of us want to do is damage the growth of the private sector, damage the growth of international business. But I think it is reasonable to make sure that the international tax rules work for companies and work for countries, and that is what we are setting out to achieve. Christine, do you want to say something, and then Wolfgang?
No, I just want to thank you for the question, because I think the issue of base and profit erosion is a really critical issue, which is clearly derived from the large intangibility of businesses around the world as digitally based businesses are growing, and it has to be addressed, particularly given the fact that many countries around the world have tax systems that are based on a territorial basis, and that's clearly a wonderful obstacle, or quite to the contrary, incentive for those that go totally digital in order to minimize or optimize, however they want to call it, their tax contribution. So we are working hard.
I agree with everything what Ed said, and we join this initiative, and we have to work on this. By the way, we also have to work on the issue of tax evasion. If we will not be more successful, we will lose a lot of democratic legitimacy all over the world. And therefore, I have to add, to be very honest, if we start a race, who is taxing companies lower than the other, we will not end the too high public indebtedness. Therefore, we have to be honest. If you have some level of institutional framework, of a functioning state, of a given social system, you need some financing. And if you don't tax companies, you have to tax transactions. Of course, I know every member of financial institution is totally in favor of taxation transactions, excluded financial transactions. But that is the experience of any minister who is responsible for taxation. I am.
Unfortunately, the clock in front of me tells me that the session has come to an end, and I know there is also a reception later. So I want to thank all of you for coming today. I hope you've enjoyed today. I hope you have found it stimulating and interesting. And I particularly want to thank my colleagues here on the panel. They've come early to London to take part in this event. Thank you very much. And I hope we're going to have a successful G7. Enjoy the reception later. Thank you.